Hello friends, this is Dr. Amarjeet Kaur, Professor of Accounting and Business Communication at the Department of Management, Gurugram University, Gurugram. This is my privilege that I am with you to talk about long-term sources of finance. This is the part 2 we are going to begin. In the part 1 we talked about the sources of finances, both internal and external. In the external we started with equity shares. We discussed the types of equity share and the characteristics of equity share, and we also started with the merits of equity share from company's perspective. Now I am going to talk about merits of equity share from shareholders perspective. What are their merits? So shareholder, they enjoy control with very limited liability. This is the first and the foremost merit from equity shareholders perspective. And then second merit is they can very easily market the shares. So let me explain these 2 points to you. So I said equity shareholders, they enjoy control with limited liability, because if you refer to my previous sessions in this regard, in the characteristics we discussed that shareholders in the equity shares, the first very important characteristics is that there is a limited liability of shareholders, which means they are liable to pay only to the extent of their investment into the shares. But nevertheless, despite being having such a limited liability, they enjoy very good control on the business operation. They exercise their power of voting, and through voting they enjoy controlling the decision making, right. They participate in general body meetings of the company and they enjoy this control. This is a very important benefit of having equity shareholders as an investment for any individual. And the second benefit to a shareholder is that they can, whenever they have need, they can sell off their shares in the market and they can actually get the money back. Of course, a person would be careful then when the price is good, as per his requirement. If that price is high, or there are people who just invest in equity shareholders with the intention to buy shares at a low price and sell them off when the market price of the share is high. So there is a very easy marketability. Stocks are traded on the stock exchange easily. So that and there is a flexibility. Whenever you want to sell, you can sell it for sure. Of course, a person would be careful about the price it is able to fetch. So in total, the equity shares are very useful from company perspective. They are a permanent source of finance. It gives credit worthiness to the company, and company is able to generate loans or issue debentures or bonds, and company has a discretion to pay dividend or not. And from the shareholders perspective, they enjoy control with limited liability and they can sell off the shares in the market when they need money, or otherwise when they see more profits in selling. So these were the merits. Coming to the limitations or demerits of equity shares, the first demerit of the equity share is it is a very high cost to the company. Second is it is a high risk to shareholders. Third is delusion of ownership and control. Fourth is no fixed rate of return. And the last demerit I would talk is last claimant to the residual asset. So let me explain these demerits or these points to you now. So the first demerit or disadvantage of equity share is from company's perspective. And what is that? That it is a high cost of funds when it comes to the cost of funds or finance cost to the company, because loans are relatively cheaper sources of finance, especially debentures, because the interest paid on loans, on debentures, on bonds, that is a tax deductible expenditure or item. So which means the expenses spent on interest on debentures, interest on term loans, interest on bonds is subtracted against the revenue of that particular years, and thus the profit comes down and the tax liability goes down for the company. So, the true effect, whatever the bracket of company, for example, if the rate of interest on debenture is 10% and company is in the tax bracket of 30%, let us assume that. So, the real cost of debenture to the company is 10% less 30% means 7%. So, that is how the debentures are, or they become a cheaper source, source of finance. But on the other hand, equity shareholders, because they take very high risk, so they expect high returns as well. So, and the company has to pay dividend according to the expectations, because so that is how the shares are considered to be high cost of finance or funding to the company. From company's perspective, another limitation is delusion of ownership and control. So, company can actually face a situation where somebody who is intending to intervene in the management, or who is intending to power or control of business operation of a particular company, he or she may consciously keep on buying share of that company and will have very high percentage of ownership, and that will give him high stake of or high power in the day to day operation, decision of the day to day operations. So, that can actually dilute the ownership, because somebody, and there are so many cases in the corporate world where companies of have bought shares of other companies, or individuals have consciously bought shares of a particular company with an intention to exercise high control on that particular company. So, this leads to a situation of delusion, right. This leads to a situation of dilution of the ownership. It's spread, instead of spread ownership, it is actually concentrated in few hands by the virtue of having the owners ownership of the share through shares. So, this was from the company's perspective. From shareholders perspective, the limitation is very high risk to shareholders, because equity shareholders have last right, or last right in income, as well as last right in assets in the case of liquidation of the company. So, both ways the shareholders are at high risk. They have no guarantee of their income being paid to them, any revenue being any income being paid to them, and they have no guarantee that whatever the investment they are making, the principal investment, would ever be paid back to them in case company goes insolvent or liquidates, right. So, that is a very big limitation or demerit of equity share from shareholders perspective. Another limitation from shareholders perspective is that there is no fixed rate of return. So, the rate of return, in case of a debenture, it is sure that it will be 7%, 8%, 10%. The rate of interest is written on the face of the debenture, and so is for preference shares. The preference shareholder would know that he will get 10%, 11%, 12%. It is written on the face of the instrument. But when it comes to equity shareholder, it is absolutely on the discretion of the board and the need of the company that shareholders would be paid any dividend or not. Though the companies which are growing, they do pay, the companies which are doing good, they do retain, as well as they do pay a good part of the income to shareholders. But the companies which are earning good enough money, but the companies which are not, there is no such guarantee. So, company may pay, company may not pay. The question is there any certainty? There is no certainty, right. So, no fixed rate of return, so there is no assured income to shareholders in the category equity shares. The last limitation is that these shareholders have claim on assets which are left after paying to the debenture holders, after paying to other creditors and other trade payables, and lastly to preference shareholders. Whatever is left, So, this becomes a limitation that you have no surety that your principal money would be paid back or not. So, these were the demerits of equity shares. Now, I would like to talk about debentures, the second source of long term finance from company's perspective. Debentures, as it's if you take the first 2-3 words, 2-3 letters of this word, it's actually debt. So, debentures are debt instruments. How? So, it's an instrument which is a proof that company has taken loan from somebody, right. So, how do we define debenture? According to Chitty J, he defined debentures in 1973, and it says like that: a debenture is a long term promissory note for raising loan capital. The firm promised to pay interest and principal as stipulated. The purchaser of the debentures are called debenture holders. This is defined by Chitty. Another definition is by the Companies Act 1956, the section 2 subsection 12 defines debentures as: debentures include debenture stock, bonds and any other securities of a company, whether constituting charge on the asset of the company or not. So, let me now explain you. So, as per Chitty, this is a long term promissory note. The simplest example of promissory note is the 500 note or 100 rupee note or 10 rupee note in your pocket, the currency we use, right, or dollars anybody would have in states, or any other country, whatever the currency they are using. So, there is a promise by that particular government. In India, the government of India promises to pay you on demand whenever, or everybody has to honor that value. That 100 rupees note has a value of 100 rupees. So, anybody whosoever is selling something or providing some service will accept that note and will give you equivalent goods or equivalent worth of services for that note. So, that is a promise by the government that this money carries this much value, right. That note carries promissory note, it will be paid by the government of India. So, same way debentures are also taken as promissory notes, right. Payment, there is a guarantee. In the promissory note, there is somebody promises in a note, in a rupee note, in a 10 rupee note, in a 500 rupee note, government of India is promising to pay you on demand, right. Here the company is promising you to pay you, once that get mature, when debentures get mature, or it is a promise that yes, I accept that I owe you this much money, right. So, it is a promising note to raise capital, to raise funds, and the company is promising to pay both interest as well as principal as is stipulated, means whatever is written on the instrument. That instrument, when I say instrument, is a financial instrument, right. It's a piece of paper, right, printed piece of paper or a soft copy saying that this is a promise to pay you this much value that I owe to you, and this much rate of interest is a prefix. Rate of interest is a prefix, 9% debenture. So, debenture is what is a promise to be paid back the principal money for, but 9% is a prefix which says that, which means which implied rate of interest to pay you, right. And the person who purchases that instrument is known as debenture holder. So, this is what is been defined by Chitty. And when it comes to the Companies Act, the Companies Act says the debenture includes everything, stock or bond. So, they are another names of debentures, right. So, debenture, stock, bond, they are same thing. When it comes to definition, they are, they all are similar things. And any other security for that matter is taken as a debenture, as a debenture. So, whether they constitute charge on the asset or not. What does it mean? So, it means Companies Act says the debentures could be issued with a charge means there is a promise, or without any surety or without surety. So, which means if let us say I issue debentures and I give a building as a surety. So, then in that case that particular debenture would be taken as charge against the building. So, it means the debentures are issued and there is a security which has been issued by the company through that asset. So, it is so that the building has been assured and has been given a charge. This is one type. Another could be that the debentures are issued, but without any charge, right. So, debentures may be issued with a charge or without a charge. So, we call them as secured debentures or unsecured debenture or unsecured debentures, right. Debentures are generally redeemable. They have a certain life, maybe 5 year, 10 year, 20 year. So, it could have many such a long life as well, but has a definite life defined that this will be paid. Generally, irredeemable debentures are not issued, that they will never be paid. There are certain types of bonds which are innovative bonds, we will discuss in future lectures. But when it comes to simple debentures as per the Companies Act, they could be secured or they could be unsecured, which means they may constitute a charge against some asset or they may not, secured or unsecured. That is how the Companies Act of India 1956 defines debentures. So, after defining debentures, let us understand the characteristics they have, what all type of characteristics or possible characteristics debentures have, we will discuss in detail, and when it comes to merits and demerits of the debentures, we will take up in future sessions. So, now today we will be discussing characteristics of debentures in detail. So, the first characteristic I want to talk about is fixed interest bearing security, second is maturity time, third is debenture redemption reserve, fourth is security, fifth is claim on income and asset, sixth is relatively cheaper source of finance, seventh is indenture or trust deed, eighth is credit rating of debentures, ninth is convertibility, and the last is call and put feature. So, we shall be discussing about these features, these characteristics in detail. So, let me explain you briefly. The first characteristic is there is a fixed interest bearing security. When I say security means I am talking about financial asset. Equities are also financial assets, so are the debentures. So, security, financial asset, instrument, there are couple of terms used interchangeably, but nevertheless this is a financial instrument from company's perspective, from debenture holder's perspective it is an asset to him, okay. From company's perspective it is a liability, okay. So, nevertheless the first feature is fixed interest bearing. So, as I said, debentures would have a prefix to their face saying 10% debenture, which means the rate of interest is fixed, right. So, that is how we call this as a security having a fixed defined rate of interest. The second feature is the maturity time. As I said, indefinite debentures are not issued. So, every debenture instrument would have a definite life, that this will mature after 5 years or 10 years or 20 years. Generally, debentures are issued for more than 5 years. That is why we are talking about them under long term financial source. Had it been only less than 1 year, that is not debenture, that is some other type of loan, because it has a short term life. So, within 1 year if any loan has to be paid, it becomes a short term loan, right. Debenture is an instrument having a maturity of longer period, and that is how it is a long term source of finance, but nevertheless that maturity period could vary from any period. So, of course, more than 12 months, then that is how we say it has a maturity time known to debenture holders in advance. The next feature, as I said, is debenture redemption reserve, DRR. So, what is DRR? So, companies have to, there is an obligation of companies to open up debenture redemption reserve. So, because debentures have maturity time decided at the time of issue of debentures known to both company as well as shareholders, and it means debentures are to be redeemed after certain life as per the maturity time or date. So, to ensure that debenture holders are paid, so there is an obligation on the company which issued debentures to create a reserve and start accumulating money into that reserve, so that by the time the maturity date is reached, company has enough money to pay back. So, this is to secure the interest of debenture holders, right. So, DRRs are opened up for that purpose. So, companies can do some goof up and can use reserves, but nevertheless the reserves would be created, though it is not a fair thing, it is an illegal practice, and it should not be, and it hardly happens, but reserves may be misutilized, right. There are certain examples in the history of the corporate. So, but purpose was to help you explain that the debentures carry this characteristic of compulsion rather of having DRR. So, this was the third feature. The fourth is security. So, most of the debentures are issued with some security, with though Companies Act gives a leeway to the companies to issue unsecured ones, but it is practically nobody would intend to buy or extend loan to a company, to a corporate without security. And the people who come forward as an underwriters, who become trustees to the issue of debenture, so they generally prefer there is a security. So, even the security could be given by them. So, most of the time debentures would have a feature of security, secured debentures. Then the claim on income and asset, they have the first right. When there is a possibility the company is going to liquidate, company is winding up, company has to be winded up or is declared insolvent, like Satyam Computers was done by, they were technically insolvent, they were declared, and company was actually shut down. It was acquired by other companies, that is a separate story, but nevertheless the claim on income and asset in any situation of winding up, the debentures holder have the first right on the income as well as on the asset. They have the first right. Unlike equity shareholders, they have the residual right, they have the last left out right, whereas debenture holder have the first right. Coming to the next feature is it is a relatively cheaper source of finance from company's perspective. One, since most of the debentures are issued with a security, and second, they have they give the first right on income, first right of asset, and they are secured. Because of all these reasons, debentures are issued at a lesser rate of interest than the rate of dividend even on the preference share. Forget about the equity source, which is the most costlier one. So, it is relatively, so relative means by if we compare it with other sources of finance, preference share, equity shares and term loans, etc., they are relatively cheaper source of finance. And not only that, it becomes more cheaper because of the tax benefit. I was just referring few minutes ago only that the interest which is paid on debenture, that interest is tax deductible item. Means when we are calculating tax for the company, we deduct tax, we deduct interest from the revenue, and then we calculate profit, and the tax liability of the company goes down. So, we actually end up the real implied cost of the debenture comes down than the face value of the interest written on the instrument itself. So, overall this is a very cheaper source of finance for the company, but every company cannot issue debenture, there are certain limitations. So, company has to have a credit rating from the credit rating agency, it has to have good profit track record only than a company can or business can. So it's not a source of finance available to every business. Then the indenture or trust deed, what is that? There is a obligation as per the law of the country that the company which opens or which debentures to the general public, before that they have to have trust deed with the trustee. In the trust deed there are certain covenants, certain certain obligations which company has to apply those. So indenture deed, trust deeds are signed by the companies giving assurance, and basically this is a deed, this is a kind of written document which talks about certain terms and conditions laid down by the trustee. The trustee is somebody who is taking care of the debenture issue and is the one or is the institution which assures that the whole issue is actually as per the terms and conditions, is very much as per the guidelines of the government of India about this, and they actually ensure that the amount is being kept in the debenture redemption reserve. So trustee is the one who takes care of the interest of the debenture holders. So this deed is known as the indenture deed. Then credit rating is must to issue debentures. So credit rating agencies, there are 4-5 major agencies, ICRA, CRI, etc. in India. They issue ratings A plus, A plus plus, etc. etc. So companies with A plus rating, they are the ones who are able to issue debentures to the general public. Another feature which is possible is that convertibility issue or convertibility feature could be offered when debentures are issued. Convertibility, as the name suggests, that debentures can be converted into shares, if they were issued as convertible debentures, means after certain periods, after 5, 7, 8, 10, whatever is defined, after that period debenture holders can become owners of the company. So they start as a lender and then they can be converted into the owners, into equity shares. So that feature is also possible. The last feature I want to talk is call and put feature. So debentures in the instrument, it may be or it may not be, but this feature is possible. Call, the company may say in the instrument that we can call up the debenture and pay them off before the maturity date. It means this option is known as call feature, call option. This is a right of the company to redeem before the maturity, and the put option is the right of the debenture holder to ask for money payment before the maturity feature. So these two possible characteristics are also there. So these were the characteristics of debentures. So I hope I was able to help you understand the second major source of long term finance, debentures, and its features. In the future lecture, we will be talking about merits, demerits of debentures, and this is now the time to sign off. Thank you very much.